So, welcome everyone. Hi, Sri. Are you able to hear me?
Hey, Abhishek. Yes. Am I audible to you?
Yes, you are.
Awesome.
Yeah. So let's get started. So, welcome everyone. I'm Abhishek and I'm part of the growth team at Dhan. Thank you for taking out your time and joining us for today's webinar. And today's webinar's topic is understanding income tax filing for traders and investors. So just a little housekeeping for everyone before we get started. If you have any questions during the sessions, please type them in the comment box. Yeah. I'll bring them up during the end of the session. And today we have with us is Vishwajit Sonagre, who is an entrepreneur, programmer, mentor, and proud father, holds a BE in computer engineering from North Gujarat University and an MS in computer science from Rosters Institute of Technology. With a background in esteemed companies like Fidelity Investment, Deutsche Bank, and Thomson Reuters, Vishwajit has contributed to the development of personal financial planning tools at Fidelity and played a role in implementing financial regulations at Deutsche Bank. He is the founder of Quico, a tax planning and filing platform, and Sandbox, a tax compliance API platform. Quico serves around 1 million individuals and small businesses, while Sandbox counts Amazon, Udan, and Airbnb among its customers. So let's get started with the webinar, guys. Over to you, Vishwajit. I'll just make you the host so that you can share the screen.
Sounds good.
Yes, now you can.
All right. Are you able to see me?
Yes, we are.
Awesome. Let me just share my screen.
Yes, we are able to see your screen.
Okay.
Yeah.
Awesome. Hi, everyone. I'm not able to exactly see who all are here, but good evening. It's month of July, and usually you see all the tax people on different platforms talking about taxes. So here I am. Thank you, Abhishek, for hosting us today. I think for those of you who don't know what the agenda is, July is a tax month. 31st July is the due date. Between 1st July and 31st July, almost 70% of India will be filing their taxes, right? Anybody who has taxable income will be filing their income tax return, and putting it in numbers, about 7 crore returns get filed in India every year. And almost 4.5 to 5 crore of those income tax returns get filed in month of July. So it's a very important month. I'm sure some of you also must be receiving Form 16s from your employer. And you must be starting to hear buzz in coffee rooms, cafes, at workplaces, in family discussions around people looking to file their taxes, looking to claim their refunds, etc. So we thought we would come in here. We've partnered with Dhan. We would come in here and talk about taxes, and maybe bust few myths. Answer most frequently asked questions, and just let you know that we are here. If you have any tax related questions, Dhan has a very active community of traders, investors. A lot of them use Quico to do their taxes, and I think there was a lot of focus from Dhan leadership team to enable this integration. So thanks again to Dhan leadership team. I think let me introduce Quico first. So for those of you who don't know, we are one of the fastest growing tax platform in India. We help individual customers save, pay, and file taxes. Now you may ask, what's the need for a tax platform if government utilities are there? If people are able to file income tax return for free from government websites? So I think that's where, in my opinion, the primary problem statement lies, right? Most people look at taxes as a reporting activity. However, I think talking to a lot of our customers, serving over 1 million customers over the last 7-8 years, what I've learned is tax filing is just a reporting activity. It's where you, at the end of the year, report your incomes to income tax department, assess tax on your incomes, and pay if there are any outstanding dues. And if you owe, if you are owed something from income tax department, then you get it in form of refund, right? However, it's already too late by the time you are filing your income tax returns, because the financial year has ended, and you can't, even if you get to learn anything around, your personal financial situation, how you could have saved taxes, there's very little you can do about it. So what we are trying to do on Queco is, as you can see, our scope of our product is to help customers save, pay, and file taxes, right? So engaging with customers early on, as the financial year starts, helping them understand their income situations, helping them pay advance taxes on time so they don't have to incur any interest penalties. And then filing just becomes a byproduct of, being organized. So that's what Queco is. We are extremely focused on investor traders in India over the last few years. There are a lot of retail investors who started participating into stock markets, primarily because as India is moving from defined benefits to defined contribution, right? Earlier, our parents used to get pension, but now our generation, or people after us, some of you must be younger than I am. We will have to save for our retirement. We'll have to build that portfolio. We'll have to build that corpus that we could in our later years use it as a safety net, as annuity in form of pension, etc. So a lot of people are starting to figure that out and starting to invest into with different goals in mind. Somebody might have a short-term goal, medium-term goal, or something like a retirement planning kind of long-term goal. So a lot of people started participating in stock markets. Now, as more and more people are participating in stock markets, we'll also have to untangle taxes for them, right? Because tax code can be sometimes complicated or overwhelming to somebody who is learning about it for the first time. So Queco specializes in taxes for investor traders. We have built a beautiful platform. Customers love it. You are able to connect your brokers and easily import your trades onto Queco and file your taxes. So I'm going to talk a lot more about product in the later half, but I think in this first half, I want to talk more about, what are the tax treatment for you who is investing into, equity, mutual funds, futures and options, derivative contracts, or even bonds and debentures, right? What are the tax treatment of investing into those segments? How do you report those in your income tax returns? What are the common tips I can share with you so that you can avoid common pitfalls? We're also going to talk about some confusing topics, often confusing topics like, treatment of losses, whether tax audit is applicable, when is tax audit applicable. We're also going to talk about some fringe topics like tax loss harvesting, right? And we get a lot of questions around tax loss harvesting as well. And then I'll make you in general aware about, 31st July due date and what are important dates to keep in mind when it comes to doing your taxes. So let's get started. I think Abhishek very quickly introduced me. I think he broadly covered everything. But again, for those of you joined late, I'm Vishwajit. I'm founder at Queco. I've previously worked at large financial institutions. I've always loved working in at the cross junction of finance and technology. And when I moved back to India, I think taxes looked like that problem statement that nobody was wanting to or willing to solve, primarily because it's uncool, or it's not a coffee table discussion oftentimes, right? So people try to avoid any discussions around taxes. What I felt was it was because of lack of really good products, interfaces through which people can take charge of their taxes and do it themselves. So that's why I founded Queco. I've been running Queco for the last 8 years. Not from Bangalore. We are based out of Ahmedabad. Oftentimes people roll their eyes, but Ahmedabad is very fast growing. Also, is considered kind of hotspot of chartered accountants. Students from, just like engineering students go to Kota, a lot of CA students come to Ahmedabad. There are great coaching institutes in Ahmedabad. What better place to start a tax platform than Ahmedabad? So we are a very young team of designers, developers, growth hackers, accountants, chartered accountants, and we are trying to simplify taxes for individuals and businesses in India. We currently serve about 1.5 million customers, and we are growing really fast. I think let's get to the core of the agenda, right? I'm gonna talk about. I think oftentimes people who are just starting to invest into markets, or people who are experienced as well, oftentimes get confused between trading and investing. And what is the different tax treatment for both? I think income heads when it comes to investing and trading is something quite frequently asked. People often get confused between capital gains and business profession income. So we're going to talk about that. Especially since Fed started raising rates, we've seen market correct. Definitely, US markets have corrected. However, Indian markets are hitting all-time high, but I think some of you might have incurred losses here and there. So we're also going to talk about how to set off those losses against other income heads, reduce your taxability. Or if you don't have other taxable incomes, then how to carry them forward so that in future years, if you have gains, you can set them off against future gains. Then we're going to talk about tax loss harvesting very quickly. Then moving on to gifting of shares. This is a very frequently asked question on our discourse forums. A lot of people have started gifting shares on weddings, on important occasions. Earlier, we used to give people gold and other kind of things. Lately, we've seen people gifting shares quite frequently. So we're going to talk about tax treatment on gifting of shares. And then we're going to talk about common tax documents. I think at the end, if time permits, I would also love to take few Q&As from audience. I know we have collected few questions that were asked beforehand, so we'll try to get through those questions as well. So without further ado, let's get started. I think first and foremost, trading versus investing. I think investing is done with a long intent of long-term capital appreciation, right? It's pretty self-explanatory. When you are investing into a particular company where you are extremely bullish about its growth prospectus, right? You are investing in a particular, a lot of people have started doing thematic investments, right? Investing in a particular sector or a particular industry or particular geography for that matter, right? If you're bullish on India, and a lot of you may end up investing into indexes that track Indian exchanges, right? So investing is usually done with a long time horizon, and the goal there is to benefit from the growth story. And it's very obvious that that would be considered capital gains, right? Because any investments made with a long-term horizon will be considered capital assets, and any gains arising out of them will be considered capital gains. However, trading is mostly done in order to take advantage of fluctuation in prices. So there are now complex financial instruments like derivative contracts through which you can take advantage of macro and micro economic situations. For example, what's happening with Russia-Ukraine war, or what's happening with climate change, Federal Reserve, US Federal Reserve increasing rates, and foreign direct investments drying up in a lot of emerging markets. So a lot of people want to take advantage of ongoing or emerging macroeconomic situation. If you're trying to take advantage of that and trying to benefit out of fluctuation in prices, then it's fair to say it's considered trading, right? I oftentimes hear prudent investors, traders saying that when the exit date, it's considered trading, but when you don't know the exit date, it's considered investing, right? That's another good way to put it. Usually in a long-term investment, you don't know when you're gonna liquidate yourself out of that position. So I think understanding difference between investing and trading is paramount in order to understand its tax treatment, right? So I hope this amply makes it clear. I think on the next slide, we're gonna talk about now how tax treatment varies for investing and trading activity. So let's go on to it. So I think this table, let's very quickly take a look at the table. The headers are segment, income head, and tax rate, which means the first column indicates all the different segments that you could invest in. Of course, we haven't covered all possible segments. There are so many different financial instruments available in Indian capital markets today, right? We are not talking about REITs and WITs. We are not talking about alternative investment funds. We are not talking about foreign securities. I think we are talking about foreign securities here, but there are a lot of other asset types that are not covered here. But I think these asset types broadly cover, the tax treatment of participating into capital markets in India. The most common one, of course, equity delivery. Anybody who is starting to invest would either invest into, purchase shares, take delivery of them into their demat accounts, or either set up an SIP on mutual fund or an ETF, right? So all the equity oriented, financial instruments are taxed in particular manner. Because government wants to encourage, long-term investments into capital markets so that businesses have liquidity to invest into plant and machinery, to invest into expansion plan, hiring more people. So usually we see favorable tax rates, right? So as you can see here, if you're trading in equity mutual funds and ETFs, especially equity and equity leaning mutual funds and ETFs, it will be considered securities capital gains. And if you hold it more than 365 days, it's considered long term. And if you hold it less than 365 days, then it will be considered short term. Now, long-term capital gains are taxed at 10%, and short-term capital gains are taxed at 15%. I think a lot of people also don't know about holding period, right? Why is that important? So Income Tax Department gives preferred treatment for investors to stay invested long-term. So long-term rates are usually lower, while short-term rates are higher, because short-term rates introduce speculation into market, and don't provide businesses or listed companies with liquidity that they need in order to invest in India growth story. So which is why oftentimes short-term capital gains, not just in India, globally, they are taxed at higher rate. Now let's talk about debt mutual funds, ETFs, and foreign securities. Now, debt instruments are considered other capital gains, and for them, the long term is if you hold them for more than 3 years, and short term is if you hold them for less than 3 years. You may ask, what is a difference between a debt mutual fund and an equity mutual fund? So, as per Income Tax Department, any asset allocation that is greater than 50% equity oriented, then it's considered equity mutual fund. And if it's greater than 50% debt oriented, then it's considered a debt mutual fund. Oftentimes, if you look at your scheme documents, it oftentimes mentions the scheme type, right? You would see enumerations like equity, debt, but sometimes you'll also see hybrid or other, right? In case of hybrid or other, you will have to look closer to understand whether it is an equity oriented or a debt oriented mutual fund. Now that we have covered equity shares, equity mutual funds and ETFs, and debt mutual funds and ETFs, let's move on to bonds and debentures. Bonds and debentures are again debt instruments. They are considered other capital gains. Any gains arising out of sale of bonds and debentures is considered other capital gains. And their treatment is very similar to debt mutual funds and ETF. Both are debt instruments, so they're taxed alike. I think one very common question oftentimes people ask us is, I'm holding this financial instruments in my demat account. Is there any taxability on it, right? So just clearing out that doubt that taxability only arises when you sell a capital asset, right? So if you purchase any of these financial instruments, there's no taxability on it. If you hold them in your portfolio, there is no taxability on it. However, certain corporate actions may result in you getting additional income. For instance, dividend is one such corporate action that comes to my mind. So if you receive dividend while you are holding a particular script in your portfolio, then that dividend income definitely becomes taxable. But at the same time, let's say if you have a dividend reinvestment plan, in case of mutual fund and ETF, then in that case also, the dividend income that gets accrued can be considered taxable income, right? But otherwise, capital gains are only applicable when you sell off this capital assets. So I think the first three rows broadly cover segments that are considered capital assets, and their text under head capital gains. Now intraday and F&O are, like I said, the goal here is primarily to take advantage or earn profit because of the fluctuating prices. It's considered business profession income. There is a minor caveat: intraday is considered a speculative business profession income, while derivative contracts are considered non-speculative business profession income. Now we're gonna both are texted elaborate. We're gonna in the later slides understand the difference between why speculative versus non-speculative. What is the difference in treatment of losses, etc. For intraday and F&O. But I think this broadly clarifies for people how different segments are taxed in India. Capital assets, we already talked about. Outside of equity shares and mutual funds, if you have sold a property, house property, or a building, or a land, agricultural land or otherwise, then that is also considered a capital asset. And when you sell it, you will incur capital gains tax on it. At the other end, something like jewelry, or if you own a car and if you sell it, if those are your investments and if you sell it, then those will also be considered as capital gains, and they'll be taxed under head capital gains income. So let's talk a little bit about the treatment of losses. Oftentimes, like markets are unpredictable. Nobody can guarantee whether they will end of the year in green or red. So oftentimes it becomes very important to understand losses and how you can take advantage of losses, setting off other taxable income, or at least making sure that you report and carry them forward, so that in future years, if you have gains, you can take them as deduction against your taxable income. So losses can be broadly, if the income can be broadly categorized into capital gains and business profession, and losses also can be broadly categorized against capital losses and business losses. Now, we talked about the holding period, long-term and short-term, right? So the treatment of long-term losses and short-term losses is a little different. Let's quickly go to the previous slide. And as you can see, long-term tax rates are lower than short-term tax rates. Long-term tax rate for equity shares where STT is paid is 10% versus short-term tax rate is 15%. So that also reflects in the treatment of losses. So long-term losses can only be adjusted against long-term gains. Reason being, long-term losses are lower rate losses, and income tax department doesn't want you to set them off against higher rate incomes like short-term gains, right? So long-term losses can only be set off against long-term capital gains. Now, I think here the concept of current year losses and brought forward losses is very important. So let me very quickly explain that to you. So any loss or adjustments happening against income earned during the current assessment year, right? So right now we are in assessment year 23-24, which started from 1st April 2023 and it will end on 31st March 2024. We are assessing income for financial year 22-23, which essentially was 1st April 2022 till 31st March 2023. So any losses that arise within that financial year and being set off against any other income head within that financial year is called current year loss adjustment. However, if you had losses in any of the previous years before financial year 22-23 and you reported them in your income tax return and carried them forward correctly, then you could also bring those losses forward and you can set them off against the current financial year incomes, right? Let me give you an example. Let's say you had 2 lakh rupees worth of losses in the current financial year, and you had you have, let's say, 1 lakh worth of capital gains in the current financial year for a different segment. Let's say equity shares, you have 2 lakh losses, and equity mutual funds, you have 1 lakh gain. Then when you set off those 2 lakh losses against mutual fund gains, those are essentially considered current year loss adjustments. However, let's say if you had 1 lakh gain in current financial year, and from previous year, if you had brought forward certain losses, then that would be considered brought forward loss adjustment. If we talk about short-term capital losses can be adjusted both against short-term gains and long-term gains. Like I explained in the previous slide, short-term gains are taxed at higher rates. So income tax department permits you to set off those losses against both short-term capital gains and long-term capital gains. Now, the important thing to understand here is these are considered capital losses, right? And capital losses can only be set off against capital gains income. They cannot be set off against any other income head. That's a very important. So if you are investing and if you incurred losses, you cannot set off this capital losses against your salary income or your business profession income, for that matter of fact. So that's a very important thing to note. Now you can, if let's say you have losses and you didn't have any taxable income, then you can carry them forward for up to 8 years in future. So in your income tax return, there is a particular schedule called Schedule CFL, carry forward losses. So you can carry those losses forward for up to subsequent 8 years. Now, one common question that we get asked is, will we have to report them in all subsequent years? And the answer to it is no. If you are not setting them off against any future incomes in those years, then you don't need to file, certain ITR forms, and you don't need to carry them forward in those subsequent years. It's only in the year that you are wanting to set them off is where you can, bring them forward and you can report them in your income tax return. So oftentimes somebody may have capital losses in this year, hence ends up filing ITR 2. If in the next year you don't have any capital gains or capital losses, then you can simply file ITR 1 for salary. Just in order to carry forward losses, you don't have to file ITR 2, is what I was trying to say. Now, let's talk about business losses and how can those be set off and what are the carry forward rules for them. We talked about derivative, any losses arising out of derivative trading is considered non-speculative business loss, and it can be set off against any other income head except salary. Now, you may ask, why can you not set it off against salary? So I think it's common sense. If income tax department allows it, then I think half of India will say, here is my salary, but here is a small business I'm running and I have incurred losses. So I will not be paying any taxes, right? So in order to avoid exploitation of somebody just reporting business losses and setting them off against salary income, it's logical that business professional losses cannot be set off against salary. Also, those are two different activities altogether. And income tax department is saying that if you are working somewhere, then you should be paying taxes like a salaried employee. And if you are running a business, then you should be paying taxes like a business people. Now, non-speculative business losses can be carried for 8 years, while speculative business losses, which could arise from intraday, can only be carried forward for 4 years. This is very important. Intraday activity is purely considered speculative, business activity, and it can only be set off against other intraday profits, or it can only be carried forward for 4 years. Oftentimes people ask why this why this kind of discriminatory treatment for speculative business losses. I think primarily because if you know, most speculative incomes are reported under income from other sources, like lottery or race horses, or even crypto nowadays is taxed at 30%. So while intraday is a speculative activity, because you are participating in regulated markets, income tax department has given you an option to report it as your business profession income. It will be taxed at slab rate, but the The disadvantage of it is that you can only set it off against other intraday business incomes, and you can only carry forward losses for 4 years. So I hope that explanation makes sense to people. Now let's talk about, I think tax loss harvesting is little untimely right now, but I would like to cover that right now. This is very frequently asked questions. Lot of HNI use, use tax practitioners, advisories accessible to them to do more tax optimization, right? Some of those tools available to them are, tax gain harvesting and tax loss harvesting. Let's talk about them so that, if that situation is applicable to you, then you can also take advantage of it. Long-term capital gains are exempt up to 1 lakh. So up until 2018 budget, when now late Finance Minister Arun Jaitley ji kind of abolished exemption under Section 1038. So all the long-term capital gains where STT is paid used to be completely exempt. The problem with that was there was a lot of loopholes where people used to take advantage. For example, if you work at CXO level at a large multinational corporation or listed company, you would get most of your compensation in form of shares, and you would wait for 365 days and then liquidate them, so you don't have to pay any taxes, right? So for a variety of reasons, that exemption was abolished in a budget of 2018, and Section 112A was introduced. Now under Section 112A, in order to safeguard interest of small investors, there was 1 lakh rupees exemption still carried forward, right? So if you have capital gains less than 1 lakh rupees, which essentially means you are a small time investor, then those are completely exempt under Section 112A. You don't have to pay any taxes on them. What you can do is, if you have such gains, let's say towards the end of financial year, then you can essentially liquidate those positions and realize those gains. And if they are less than 1 lakh rupees, then they are completely tax exempt, right? It's called tax gain harvesting. Now you may ask, I am bullish about that share, and I want to stay invested in that position. What do I do in that case? Income Tax Act in India does not explicitly prohibit it. So you can reacquire that position into your portfolio on the same day, or T+2 settlement manner, and still be invested, but at the same time you are able to harvest the gains, right? Now in US markets, IRS, which is the equivalent of Income Tax Department, definitely has a wash sale rule, where if you reacquire the position within 30 days, it's called cooling off period. If you reacquire it within 30 days, then you will not be able to take advantage of the exemptions, right? So, however, it's not explicitly mentioned in Income Tax Act anywhere, and we often see it as a practice where people take advantage of it to save off of capital gains tax. Now, what is tax loss harvesting? Contradictory to tax gain harvesting, tax loss harvesting essentially means that if you have any realized gains, let's say I had, sold my ESOPs and I had 10 lakh rupees ka capital gains, and if I have any unrealized losses in my portfolio, right? That means positions I'm holding are, if I mark to market, then they are in red, they are negative. Then what I could do is I could sell off those positions, realize those losses, and set them off against the realized gains that I had from the ESOP. That way I can reduce my taxable income and save on taxes, right? That's called tax loss harvesting. Usually both of these activities are done towards the end of financial year. So I think it's a little untimely right now, but I just wanted to put it out there so that you are aware that these kind of tax planning tools are accessible to investors, traders. Now let's come to gifting of shares. This is again, like I said, very frequently asked questions. It's very popular lately. Most brokers have started offering features where you can gift shares to, another demat account. So what are the tax implication of gifting of shares? So I think when we talk about gifting of shares, we have to remember two things. Gift amount greater than 50,000 and gift amount less than 50,000 is one thing. And the other thing is, who are you gifting to? Whether the receiver is a blood relative or a relative or not, right? These are two important concepts. If you understand those two, then I think it becomes really simple. So if the gift amount is less than 50,000 rupees, now you may ask, how do you calculate gift amount? So if it's a listed security, the fair market, the last traded price of that security helps you determine the gift amount, right? And if it's an unlisted security, then the fair market value of that security can help you ascertain the gift amount. So if the gift amount is less than 50,000 rupees, then it's completely tax exempt. It's first of all, for sender, it's always tax exempt because sender is not selling and realizing capital gains out of it. So for sender, it's always non-taxable. But for receiver, it becomes exempt income because it's less than 50,000. Now you may ask, what does that mean? That means there's no tax applicable on it. However, you do need to report it in your income tax return under exempt incomes. Now, if the total amount of gift is greater than 50,000 rupees, then again, it's not taxable for sender. However, if the receiver is a relative, then it's exempt. But if the receiver is non-relative, then in that case, it will be a taxable income and it will be taxed under income from other sources at slab rate. Now, what's the definition of relative? I think it's very simple. It's blood relative or your spouse, right? These people, if you gift shares to them, then it's completely tax exempt, even if it's greater than 50,000. Now you may ask, what if the relative later sells those shares? What happens then, right? Will that be taxable or not? So I think in that case, what you need to consider is the two legs of this transaction, right? The first leg of the transaction is the sender sending the gift to the receiver. If the receiver is blood relative or a spouse, then it's completely exempt in that first leg, right? However, now the receiver has those shares in their demat account, or if they are in physical form, then in physical form. And when that receiver at a later date sells those shares, then they'll be considered capital gains and they'll be taxed just like any other securities. So I think that's very important to understand. Oftentimes people feel that, when gift is received, it's exempt, and when it's sold, it's exempt as well. Or sometimes people believe that, even when it's received, it's taxable. So you have to understand these rules in order to determine whether it's taxable or not in your particular situation. I think most common situation that I come across is, parents gifting it to their children over weddings and those kind of occasions. We also see between spouses exchange of, shares in form of gift. So these are the common use cases, right? Where there's not a taxability at the time of receipt. However, at the later date, when you sell it, you will have to pay capital gains. Now, I think in this second part of the conversation, I want to talk about most common tax documents. I think Form 16, everybody would know. It's tax credit statement. It's issued by your employer. If you're salaried, you should receive it by 15th of June. We're going to talk about Form 26AS, annual information statement. I think capital gain statement and tax PML statements are very important in this discussion, right? Because our audience is traders and investors. So we're going to talk about those. And at the end, we're also going to talk about which ITR forms, right? Do you need to file as trader investor? So let's jump right into it. I think Form 16, I don't have to spend a lot of time on. In the interest of time, it's it's a TDS certificate that's issued by your employer to you. It contains two things. It contains all the TDS withheld from your salary and deposited with income tax department against your PAN. So the part A is the tax credit statement and part B is a breakdown of salary income, right? So that's where you will actually see your taxable salary income and the tax payable on that salary income. Form 26AS is increasingly losing its value because it only now contains your TDS credits and your TCS credits. Most of the information from Form 26AS now has been moved to AIS, and we're going to talk about AIS in a little more depth because it's the most important text document right now. But Form 26AS right now can still, you can access your TDS and TCS credits. Now, TDS, everybody understands, right? So when you earn income, the payer is responsible or liable to deduct TDS and deposit it with government. So that's TDS. And TCS is essentially government's way of when you make expensive purchases, right? When you purchase jewelry or car or you make foreign trips. So government is asking whoever that you are purchasing it from to kind of collect some taxes from you and deposit it with the income tax department. When you file your income tax return, you can claim those in form of tax credits. And if you don't have tax liability, then you can also get a refund. Let's talk about AIS. Like I said, the most important tax document right now. So over last few years with digital transformation within government, right? Aadhaar is getting linked to PAN. Almost all Aadhaars are linked to PAN now. 30th June was the deadline for everyone to link it. Now there's a penalty on it. More and more information is correlated to your PAN, right? So if you are your bank accounts are now linked to your PAN, your demat accounts are linked to your PAN, but also your property transactions are linked to your PAN, and your foreign travel is linked to your PAN, right? Your credit cards are linked to your PAN. So what happens is there are a lot of entities that are required to file certain forms and report the information to income tax department. Now, who are these entities? These entities include banks, NBFCs, depositories like CDSL, NSDL, so that covers everybody who's trading in markets, AMCs, asset management companies. It also includes listed companies who pay out dividend, credit card issuers, right, are covered under the Act. So these are all the entities who have to file Form 61A to income tax department in order to disclose, what's called account-based reporting or person-based reporting. So any transaction against a particular PAN number or any transaction against a particular account, right? So that's how income tax department gets all this data, and they furnish it in form of AIS, annual information statement. And it's very easily accessible from your income tax account. If you log in onto your income tax, into your income tax account using your PAN, then you should be able to download your annual information statement. Now, why is this document important? It's important because any information that's available in AIS and not reported in income tax return can potentially result into an income tax notice. And this is because income tax department with a lot of investment in tech is now able to do data mine and send bulk notices to this kind of mismatches, right? So it doesn't require any human intervention, and algorithms decide whether all the information or computer programs rather decide whether all the information available in your AIS is reported into your income tax returns or not, right? So we have starting this year, we have started a practice on Quico that both our products and our tax experts make sure that any information, any and all information AIS must be covered in your income tax return before we let you e-file your income tax return. If you are filing offline somewhere, if you are filing on another platform, please make sure that some obvious things to miss out are like dividend incomes, right? Oftentimes brokers tax PNL does not include all the details of dividend incomes. Sometimes AMCs directly pay out dividend incomes to unit holders, right, where your broker is not aware of it. So in that case, it's always advisable to look into your AIS and make sure that you report those income sources in your income tax return. Now, capital gain statements, if you are investing into mutual funds, there are two ways that you can, get the capital gains statement. One, you can go to your broker. Most brokers, including Dhan, has, PNL statements available through the portal. And you can alternatively also go to CAMS and Carvi. These are called RTAs, right? So every time a mutual fund units are sold or purchased or sold, RTAs are intermediates through which those transactions pass, and hence they have record of all the mutual fund transactions. So you can download your capital gain statements from CAMS or CARVI as well. Let's move on to tax P&L statement. Now, tax P&L statement is very similar to capital gain statements. The only difference is it covers not just capital gains, but it also covers your business profession incomes, right? So any income arising out of intraday trading or derivatives, whether it is currency, cash or commodity, is covered into your tax P&L statement. Now, I think this is where Quico really shines, in the sense what we have done is we have integrated with all major brokerages. We work very closely to streamline the P&L reports, to make them in sync with Income Tax Act and the reporting requirements. And we consume them programmatically. So when you connect your Dhan account, we directly read your P&L report that Dhan has generated, and we report that into your income tax returns. We calculate appropriate capital gains and business profession income and represent your tax liability based on that, right? And that makes things really easy for trader investors. However, there are certain things which are very difficult to capture even for a broker, right? I'll give you a few examples. Let's say you moved a portfolio from a broker A to broker B. Right now, broker B has no clue about your cost of purchase, right? Your cost of acquisition is unknown to broker B. And when you sell that position from broker B, oftentimes for broker B, the capital gains is a difference of your cost of acquisition, which is not available, in that case 0, and your sales consideration, right? So in that case, you will see your capital gains to be inflated. What most brokers have started doing is started providing interface through which you can also capture the cost of acquisition if you move the portfolio. There are a lot of corporate actions which are very difficult to reconcile, right? Indian capital markets are emerging markets. There's a lot of ground covered in terms of technology and innovation, but there's still a long way to go. So, for instance, corporate actions are announced in press releases and through notifications. It's very difficult to kind of ingest that data programmatically and reflect it on millions, if not tens of millions of investor traders, trade books, right? So this requires very complex processing on the back end, right? Where consuming those feeds, first of all, getting those feeds accurately, consuming them, and then recalculating trade books for all the investors who have those scripts in their portfolio. It's a very complex transaction, and hence oftentimes you find that your data might be broken or a column or two may be missing. So in that case, I always recommend, right, as a taxpayer, as an investor trader, if you are reporting your incomes, please make sure don't do it blindly. Always double check, tally, use common sense, verify the information before you file your income tax return. So I think tax P&L statement you can download from Dhan's portal. I think coming on to ITR forms, oftentimes we get questions asked, which ITR form, do I need to file? I have so and so income situation. And I think it's simple, but for somebody who is very new and is filing for the first time, can be a little overwhelming. So I think let me simplify it. So ITR 1, there are only 4 individual ITR forms, ITR 1 through 4. I think the simplest one are ITR 1 and ITR 4. So let's talk about them first. ITR 1 covers salaries. So, right, anybody who is salaried and only has, let's say self-occupied house property where you have a home loan, or you have other income sources like savings interest or FD interest or PPF interest, then you can simply get away by filing a very simple ITR 1 form. It's a 1-pager form. Income tax department also gives all these names. It's called Sahaj. ITR 1 search form. So it's the simplest ITR form that one could file. ITR 4 is another very simple form. So it's announced by income tax department, especially for micro businesses, right? So these are freelancers and small proprietorship businesses who could get away without maintaining books of accounts. And simply claim like 6% of their total turnover as taxable income, and file their income tax return, pay taxes on it and file their income tax return. However, if you want to report losses arising out of business, then you will have to, you cannot file ITR 4 and you will have to go to ITR 3. So now ITR 2 is essentially covers over in addition to ITR 1, it covers capital gains income. NRIs also cannot file ITR 1, so they'll have to file ITR 2 at least. So capital gains are covered into ITR 2. That includes both long-term and short-term gains. Also gains coming out of, securities, real estate capital gains, and any other capital gains are covered into ITR 2. The last and the most complex one is ITR 3. ITR 3 covers everything in ITR 1 to 4, but also business profession income. Now, like I said, ITR 4 is for just micro businesses. ITR 3 is for businesses of all scale and size. And especially, trading and manufacturing businesses. Also, trading businesses like trading into securities can be reported into ITR 3 as well. I often get asked this question that can trader investor file ITR 4? And the answer is absolutely. If you think that if your turnover is less than 2 crore, then you can take advantage of presumptive taxation scheme and file your. However, the small caveat is if you opt out of presumptive taxation scheme once, then you cannot opt in again, right? So make sure that you clearly know what you're doing. Now, I think tax audit is the last topic I wanted to cover before I very quickly show you how you can use Quaco to do your taxes. And I think it's oftentimes a black box for traders, investors, because every other person they talk to, they get a different answer. So what we have done on Quaco is we have created a very simple presentation. Our algorithm determines whether tax audit is applicable to you or not. Mind you, we are not a CA firm, so we can't actually perform audit. But what we can definitely do is tell you based on your income situation whether audit is applicable to you or not. What you can do then is you can find out a chartered accountant who can audit your books of accounts, right? Audit is applicable if your turnover is greater than 10 CR. If you are a securities trader and all your transactions are through your demat account, then highly likely that you will not fall into this bucket. But just in case you are, high frequency trader and you regularly trade in intraday and FNO, and that's your primary activity, then your turnover could exceed 10 crore. In that case, audit is applicable irrespective of you making profit or loss. Now, if your turnover is less than 10 CR, in that case, you have to look at, whether your profit is greater than 6% of turnover or not. If your profit is less than 6% of turnover, then usually it's advisable to get your books of accounts audited, right? Because in this case, income tax department would highly likely want to know that why your profits are less than 6% of turnover, right? And a certified chartered accountant can, look at your books of accounts and kind of certify it for you that, your profits in reality are less than 6% of your turnover, right? So in that case, we recommend you to find a good chartered accountant and get your books of accounts audited. I think oftentimes people come and ask us that, hey, my chartered accountant recommended me that tax audit is not applicable. Why are you showing it's applicable, right? I think common answer is a chartered accountant is human. What we have done is based on Income Tax Act, we have very strictly adhered to whatever the rules are. But then there are exemptions, right? So for example, if you haven't opted out of presumptive taxation scheme, then, if your turnover is less than 2 crore and even if you have incurred losses, then there is no audit applicable, right? So I think, like I said, our algorithm should just be used as a reference point, as a North Star. And then you can always go refer to a tax expert to actually determine whether tax audit is applicable to you or not. Now, let me very quickly show you how you can file your taxes using Quaco. So I'm going to switch to a web browser here. Let's see. Okay. So I'm already on Quaco. So let me start from beginning. I'll take about 2.5 minutes just to show you. So this is Quaco. If you haven't visited the website, We help individuals do their taxes. We also help businesses to do their GST and TDS returns. But for this discussion, we're going to focus on individuals and filing their income tax return. So when you either sign up or log in, you can use, email password. You can also sign in using Google. But what our customers really love is that they can sign in using their broker. So in my case, I'm going to log in using Dhan. And I'll try to log in our test account to see if I can show you how Quico and Dhan integration works. Okay, let's see. Okay, it doesn't take a genius to figure that out. Okay, let's see if I can. Cool. So as soon as you log in using your Dhan account, you would be redirected to Quico. And what this integration does is you are just like you would log in into Pinterest using Google, you are logging into Quico using Dhan, and you are giving consent to Quico to access your profile information and your trades to help you file your income tax return. The integration is completely within your control. At any given time, you can go to integrations and you can revoke the Dhan integration, and you will be able to disconnect your Dhan account and your Quico account. Now, for sake of this discussion, I'm gonna very quickly show you how you can connect your Dhan account and import your capital gains and business profession income. So, like I said, Quico helps save, pay, file taxes. We're gonna stay focused on filing right now because 31st July is the due date. So let me click on start filing, and you have two choices. You can import from ITD or you can do it yourself. I think import from ITD is pretty cool. It imports all the data from your pre-filled JSON. So everything income tax department has on you will be pre-filled, auto-filled onto Quico's platform. So for sake of this conversation, I'm gonna say I'm gonna do it manually. And this is what our customers really love. For all the information, you can, authorize Quico, connect your tax accounts with Quico, and allow Quico to import data automatically into your income tax return. So I can import my salary information like that. I can import my tax credits from tax department like that. But let's quickly see how you can import your capital gains, right? So if you go to capital gains, on the left-hand side, it's pretty self-explanatory. In order for you to file your income tax return, you have to report your incomes, your tax breaks or deductions, your tax credits. So that includes your TDS, TCS tax credits, or any advance tax you may have paid. In addition to that, you also have to report a bank account where you will, get refund. So that is all the information needed. So I'm right now navigating to incomes, capital gains, and I'm presented three different choices. I can import from broker, I can import using an Excel template, or I can add trades manually. And most of our customers end up choosing import from broker. These are currently all the brokers integrated. We are continuously adding more and more integrations on the platform. But for this discussion, let's choose Dhan. Because I had already logged in and given consent to Dhan, it's currently showing me that, it's gonna use the integration to import data. It also indicates to me what data feed includes which segments, and data feed does not include which segments, right? So I'm not sure if bonds and debentures are yet supported on Dhan, so I don't think we have to worry about it. Mutual funds, you will have to explicitly enter mutual fund transactions if Dhan supports it, because it's not currently included in the data feed. But let's click on continue, and this is where the magic happens. We are now connecting to your Dhan account and using your PML that Dhan has generated. We are importing all your trades into Quico. We're calculating capital gains and business profession income, and using it to report, file your income tax return, right? So this is my test account. So I may have few transactions here and there just so that I can do this kind of demos. So as you can see, please don't judge me. I mean, somebody from my team must have done the trade. So I have purchased and sold an Adani Power share, and I've incurred 20 rupees losses from that transaction. So it immediately categorized, my transactions into shares, and because it was held for less than 30 days, it's considered short-term loss. If I have more demat accounts, I can simply click on add and follow the same process. What Quico also does is it imports my trading activity from my Dhan demat account, right? So as you can see, it already imported by trading futures and options from my test account. I've incurred 45 rupees worth of losses. So those are already covered. What Quico also does, it imports all the expenses. So if there was any brokerage charge or any kind of security transaction tax, GST was charged, right? Any clearing house charges, any exchange transaction fees, all of them are accounted for. If you have additional expenses, right? If you have taken subscription to an online platform or something like that, then you can also claim those expenses in your income tax return. So this is how easy the integration is. In the interest of time, I am not going to be able to show you the whole journey, but I think, like I said, it's pretty self-explanatory. You can just simply connect your sources and import different income sources. Similarly, you can import tax credits from income tax department, and finally, you can review your tax computation calculated by Quico, and then e-file your income tax return. So that's how easy it is to file your taxes on Quico. I hope the conversation, if not anything, acted as a kind of a jump start to your tax journey. I oftentimes tell my team and my customers that penny saved is penny earned. So if you take charge of your taxes, you'll be able to save more taxes, and you can invest that money, which can help you generate wealth or meet your financial goals. So I always recommend people don't delegate your taxes to someone. Take charge of it. Try to do it yourself. You'll learn a lot of things about your financial situation by looking at your taxes. I think we can take a few questions, Abhishek, and then we can wrap up the webinar.
Yeah, sure. So we'll quickly take a few questions so that as we don't have enough time in our hand right now. So the first question is, are there any specific tax planning strategies that traders and investors can employ to optimize their tax liability?
So like I said, there are 3 or 4 common questions that we get asked, right? Number one is, can I, capital gains are special rate taxes. Oftentimes people feel that, if they report capital gains as business professional income, which is slab rate income, they are able to, pay fewer taxes. But I often ask them to defer back to the intent. If your intent was not trading and you were just a long-term investor, then I think you should stick to the tax treatment as prescribed by income tax department, right? So that's one common thing that we see people asking us. I think the second thing is just in general be aware about taxes on trading and investing. And like I said, something as simple as in order to save a couple of thousands of rupees in tax compliance cost, oftentimes people file ITR 1 and don't report their capital losses or intraday losses. I understand it always pinches to pay any fees to tax professionals. But if you report those losses in your income tax return, in later years, they could save you thousands in taxes, right? Or tens of thousands in taxes. So don't be lazy. Don't try to save a few pennies or bucks. Those losses can later offset, a lot of tax liability for you. And I think the third thing, like I said, being generally aware about tax gain harvesting, right? It can help you, kind of. It can help you earn tax-free returns, and B can also act as a good annual event where you reorganize or rebalance your portfolio, right? However you look at it. So those are, I think, common things that I would ask investor traders to stay focused on. More importantly, take charge of your taxes. Don't delegate it to someone.
Great. So we'll take one last question, Vishwajit. So the question is, what are the consequences of failing to report trading or investment income accurately on income tax returns?
That's a very good question, and I think oftentimes, I see customer queries on forums, on our support center, also in meets that we conduct with customers. People saying, "यार इसमें बहुत trading नहीं किया ये demat account में, इसको report नहीं करेंगे तो चलेगा." Right? It's a very common thing that I overhear, right? And I think it used to work few years ago because the data wasn't connected. But like I said, with annual information statement, all the data, every single contract note flows back to income tax department. So whether they know or not how much, what are your gains or losses, they definitely know that you have conducted that financial transaction, right? And if you don't report it in your income tax return, you are highly likely to get an automated notice. The only avenue then you have is, hire a chartered accountant, spend a little extra on responding to notice, and then again filing your income tax return by disclosing that information. So I would always suggest that don't try to cut corner. Report all the information in your income tax department. You already it's already reported to income tax department, so there's no point hiding those kind of transactions.
Right. Awesome. So thank you so much, Vishwajit, for this insightful session. I'm sure all the attendees got a lot of new things to learn. And so guys, if you want to access this webinar anytime you want, this webinar was live on our YouTube channel. So if anyone has missed this webinar, or you want to share this with your friends, you can do that. You can share the Dhan's YouTube channel. It is live on that. You can have access to that anytime you want. And thank you so much, Vishwajit, for this insightful session.
No, absolutely.
Thank you so much for joining in.
Thanks for inviting. And if anybody has any questions, they can shoot it our way, and we'll be more than happy to help. Awesome.
Yeah.